I was talking to an old friend the other day who happens to be a teller at a bank, and because banks are considered essential, he's still working right now during the pandemic. And I asked if business has been super slow, and he said no. In fact, the banks have been extremely busy with people coming in and literally emptying out their bank accounts. He said people are withdrawing all of their money and literally walking out of the bank with $20, $30, $40,000 all at once. And my first thought when I heard this was, wow, that's incredibly stupid. Why would anyone decide to do that? But then I realized we have seen a lot of articles over the last couple weeks talking about how all the banks out there are soon gonna fail and how the banking sector is on the verge of collapsing. Well, I don't necessarily think you should take all of your money and put it under your mattress. This did lead me to wonder if we should be concerned about our money and how likely it is for us to see a widespread banking crisis. This whole notion of everybody running to the bank to take out all of their money is known as a bank run, which occurs when people begin to believe that they will lose all of their money due to the possibility of their bank becoming insolvent. But as everyone tries to collect their money in the form of cold, hard cash, it may end up leaving banks unable to actually provide those funds. It's kind of a catch-22 because people fear that their bank will fail, so they empty out their account, but this is actually the cause of bank failures. These bank runs can destabilize banks to the point where they run out of cash, forcing them into bankruptcy. And this can be seen on a small scale at local individual banks or on a large scale that threatens the big banks that run our economy. In worst case scenario, leading to a systemic banking crisis in which all of the banking capital in a country can be wiped out. A lack of trust in banks goes all the way back to the Great Depression, when the majority of banks failed, and as a result, people lost their entire life savings. The Federal Reserve System was largely at fault for the Great Depression, but much of the economic damage that resulted was due to bank runs. To try to build confidence in the banking system following the Great Depression, the government formed the Federal Deposit Insurance Corporation, or FDIC, an independent agency that protects consumers' bank deposits in the event of similar catastrophes. And they do this by insuring your money. As you probably know, your money at almost all banks is insured up to $250,000, meaning that if you have that much money in a particular bank and your bank fails, you'll get that money back. The FDIC wants you to feel like your money is safe, primarily to prevent bank runs. If you feel that your money is safe, then there's no reason for you to empty out your bank account, right? But can you really trust the FDIC? I mean, they did almost go bankrupt in 2008. For me, it's a little hard to believe that the FDIC will be able to insure $14 trillion, which is the amount of insured deposited money out there sitting in bank accounts right now, when they only have $110 billion on their balance sheet. Fortunately, I think you guys are gonna get a kick out of this one. The FDIC put out this creepy fucking video last week to try to brainwash us into trusting them with our money. Let's see if this gives us a little reassurance.
We're living in unprecedented time. At a time of a pandemic like this, it is way too easy to get confused and to have fear about what you should be doing with your money in your accounts. Your money is safe at the banks. The last thing you should be doing is pulling your money out of the banks now, thinking that it's going to be safer someplace else. So if you're talking about having your money in a safe place, please keep it in an FDIC insured bank.
What? It's funny, this video, like a lot of things that the government tries to do, not surprisingly backfired and caused people to actually want to take their money out of the bank more than they already wanted to. So if you're like me and don't feel very confident in the FDIC program, I think that's pretty understandable. But rather than focusing on the FDIC's ability or inability to cover everyone if a collapse in the banking sector was to happen, I actually was more curious to discover how likely it is for banks to fail as we head into the recession. Looking at the 2008 financial crisis, hundreds of banks failed, with several of those banks and other massive financial institutions actually going out of business. Lehman Brothers was probably the most notable since it was the largest bankruptcy filing in US history, with the company at the time holding over $600 billion in assets. But not only did the 2008 financial crisis hit the banking industry hard, it was actually caused by the banking industry. Simply put, due to deregulation in the industry, many banks and financial institutions began investing in risky securities and hedge funds. They got greedy, and in order to make more money off of these investments, they tried to get more people to take on home loans, so they created very enticing interest-only loans and made them affordable to subprime borrowers, basically people with bad credit scores and people that are more likely to default on those loans. And that's exactly what happened. People stopped paying their loans, and it ultimately led to the housing bubble bursting. And to make it all worse, at the time, banks stopped lending, leaving consumers without access to cash. Since then, banks have been under careful watch and under a lot of scrutiny. And over the past couple weeks in particular, banks have gotten a lot of attention. There's been concerns that banks might be returning too much of their profits to shareholders, leaving them exposed in the event that we have a very severe and long-lasting downturn. And that's why many banks are in talks about cutting their dividend payouts. Due to the fact that deregulation of banks leading up to 2008 resulted in the last financial crisis, Steve Mnuchin, the US Secretary of the Treasury, has been criticized for weakening many of the safeguards that have been put into place to prevent a repeat of 2008. And bank lobbyists have been able to leverage this whole pandemic as a reason to deregulate even further. In other words, things have loosened up over the last couple years, regulation is slipping, and banks are starting to regain more of the freedom that they had 12 years ago. There's definitely a handful of reasons to believe that the banking industry isn't doing so good at the moment. Many big banks today are in fact on the verge of bankruptcy, and you could definitely argue that the majority of them have greatly over-leveraged their debt. And many people view the fact that the Federal Reserve is loaning money to the banks in the form of overnight repos as a bad sign. On top of all this, it's really hard to gauge what kind of financial position big banks are actually in due to their sketchy accounting practices that allow them to cover up and hide a lot of their debt. Knowing how important the banking sector is in supporting the overall economy, it's concerning that right now on average, stock prices for big banks are down about 40% this year, which is worse than the overall drop in the Dow Jones. JP Morgan, Chase, Citigroup, Goldman Sachs, and Morgan Stanley are all taking some pretty serious hits right now. But while the industry may have some issues, believe it or not, banks are on more solid footing than they were prior to the 2008 financial crisis. Comparing then versus now, banks are currently required to undergo regular stress tests designed to ensure that they can make it through the toughest of times. And overall, all major US banks have much higher levels of capital than they did going into the 2008 crisis. Many of those big Wall Street banks that I just mentioned have substantial levels of capital and liquidity in excess of regulatory minimums and buffers. And these giant players in the banking industry have all agreed to temporarily suspend stock buyback programs in order to ensure that they have enough capital that they need for loans and other daily operations. Looks like they learned a thing or two from the airline industry. And even though I said the industry is starting to see some deregulation due to a lot of the regulations that were previously put in place after the financial crisis, they now have far less ability to make risky bets with their own balance sheets. Kind of like a teenager that can't control their spending with their parents' credit card, mommy and daddy came in and laid down a new set of rules. And those rules have positioned banks in a good place for now. If you're one of the people that have been worried about banks failing, you'll be happy to know that not only are banks not at fault for our current economic situation, they're actually part of the solution. Banks are playing an essential role in distributing the trillions of dollars that are being pumped into the economy on behalf of the recent stimulus programs. My thoughts on the stimulus package. Although central banks, aka taxpayers, are providing those trillions of dollars, banks are being asked to serve as the transmission mechanism, whatever the fuck that means, to ensure that money finds its way to the companies and consumers who need it most. And keep in mind, this isn't a financial crisis. This whole situation was all triggered by the pandemic. So as of now, the overall consensus is that banks will be fine. And actually at the moment, big banks aren't doing all that bad. With interest rates at rock bottom levels, Everyone is refinancing their mortgage right now. But let's be honest, we're pretty much in a recession, so tough times do lie ahead for US banks, and the coming months and possibly years could be a struggle. A recession is never a good time to make loans, and it's often when a lot of people start defaulting on their loans, leading to a string of excruciating credit losses for banks that will have a huge impact on their balance sheets. And super low interest rates, which the Fed just dropped to 0%, will also take a toll on profits. The 2008 crisis showed that central banks can struggle to increase these rates, so it will take some time for banks, even after we've recovered from this whole situation, to start receiving the same amount of profits that they were previously making from lending only a few short months ago. But as of now, you don't have to worry about banks running out of cash. There's no need to empty out your bank account. Over the last few weeks, the banking industry has seen more volatility than it's ever seen before, and so far, things are still operating as they should be. And if you're looking to invest in the banking industry, right now is probably a pretty good time to do so. All right, man, that's it for this one. Subscribe, watch this video here. I'll see you next time. Peace.